Right, good morning, everyone, and welcome to our quarterly webinar on financial reporting. And this is a very special edition of our webinar, as I'm very happy to say we have a special guest who is Richard Barker, who is a board member of the International Sustainability Standards Board, who will join me in conversation in a little while. And we do try to cover a combination of regulatory reporting, financial reporting, and sustainability issues. And over recent sessions, we've increasingly covered developments in as new standards have been developed in Europe, the European Sustainability Reporting Standards, but of more immediate direct relevance to the UK. International standards issued by the International Sustainability Standards Board, which look likely to become mandatory in the next couple of years in the UK. The ISSB issued its first two standards in June this year, and the UK government is progressing towards the mandatory adoption of these for the UK. They will become UK sustainability disclosure standards, much as we talk about UK adopted IFRS. Their work looks likely to be completed by June of next year, and whilst the details aren't being finalised, certainly some of the largest listed companies could be applying these as early as 2025. So these are imminent new standards in the UK. Now, in a minute, I'll ask Richard to provide a short presentation, and then we will have a Q&A session. But do please add any questions you have in the Q&A function, and I will try and incorporate them into my conversation with Richard. Now, to introduce Richard, well, as I say, he's a full-time member of the International Sustainability Standards Board, and he's been appointed there since June of last year. Before that, he was Deputy Dean and Professor of Accounting at Saïd Business School at the University of Oxford, where he led Saïd's sustainable business initiatives. In addition to that, he also has obviously issued a range of academic papers, but also sat on a number of committees. And actually, Richard and I have known each other for a few years, because when I worked at the Financial Reporting Council, Richard was one of a group on the Corporate Reporting Council who provided me with invaluable advice in the development of UK standards and the FRC's work in influencing the IASB, and indeed influencing developments in corporate reporting by the UK government. So with no more to add, I will now ask Richard to join us, and thank you so much for being here, Richard, and we'll pass over to your presentation.
Thank you very much, Anthony. So it's great to be here. Thank you for inviting me. I'm just going to give you a few brief slides to introduce and give an overview of ISSB. Of course, recognizing that this will be familiar to many, but levels of familiarity will be somewhat different. So just 5 slides, I think. This first one is a scene setter, making the point that ISSB standards are focused on the interaction between companies and their investors. So on the left-hand side, you have standards that are beneficial to investors in making investment decisions. And on the right-hand side, you've got standards which in principle are not excessively costly for corporations in that exchange with companies. And there's a mutuality here, right? That we see already in financial accounting, but I think is not as well understood as it will be in sustainability reporting. And by that I mean, there's a lot of pushback on sustainability reporting about it being costly and a big compliance exercise and difficult to do and all this kind of stuff. There was probably similar pushback when the SEC first introduced accounting standards back in the day, right? But nobody these days is seriously saying don't have a finance function anymore and don't do financial reporting anymore. And the reason for doing it is because investors won't invest if you don't, right? Apart from the fact that it's a financial accounting is mandatory, there is a win-win in that, right? The more transparent the company, the more readily comparable it is against a set of standards, the easier it becomes to attract capital and the lower the cost of that capital. And so this is true for sustainability reporting just as much as it is for financial reporting, for financial accounting. For us, the materiality lens is exactly the same as it is for the ISSB. So the materiality traditionally in financial reporting is focused on the financial statements because that's the heart of financial reporting. But actually, the broader test in the conceptual framework is useful information to investors in making decisions. These days, so that means including sustainability reporting, right? Because the focus of financial accounting is what has happened in the past, and the usefulness of financial accounting is grounded in the past being a useful guide to the future, effectively. But the future is changing, and we're in the middle of a dramatic sustainability transition. And in that context, anticipating the future is far more important now than it has been in the past. And investors need information to complement financial accounting. So we think of sustainability reporting as being a part of financial reporting. It's reporting to investors on investment decisions. And that's super important. I think it's easy to think of sustainability reporting as being sort of CSR reporting, as being off to one side, as being a sort of a separate accountability type statement all around impact on stakeholders, rather than being fundamental to corporate communication. But what we're increasingly seeing is that fundamental nature. So it's important to emphasize that up front. So the way we go next slide, please. So I should want to forward the slide myself and realize I couldn't. So the way we think about this is that the IASB is setting the global baseline for sustainability, for investor-oriented sustainability reporting. So the idea here is that ISSB standards provide the information that investors need globally. Bear in mind that sustainability is a global issue, right? So a ton of carbon in one part of the world has exactly the same impact on global warming as a ton of carbon somewhere else. Corporations with global operations, global value chains, upstream and downstream, do not benefit from having multiple different sets of standards and measurement requirements in different jurisdictions. It makes no sense. And investors likewise want to be able to compare on a consistent basis. So I think it's pretty clear that I don't think anybody would reasonably disagree that there should be a global standard for investor-oriented sustainability reporting. So our aim is to provide that. We're in a somewhat better place than the IASB was back in the day, because there's no US GAAP equivalent, right? So the long-standing outlier on global compliance is not there, as it were. And in fact, the SEC has the same investor orientation that we have. So there's good alignment there in principle. Having said all of that, what this graphic illustrates is additional building blocks, right? So individual jurisdictions, which will have different electoral mandates and different societal issues and needs and priorities and so on, can and indeed should add additional sustainability-oriented disclosure requirements over and above the baseline of investor reporting. So reporting to investors doesn't meet the demand for sustainability information and sustainability accountability, as it were. But we see it as a jurisdictional issue to add to our standards. Okay, next slide, please. So we have two standards, as you will probably know, issued in June of this year, not that long ago. S1 is very broad. It's a kind of a combination of the conceptual framework and IAS1 and IAS8 to a degree as well. It sort of defines what sustainability is. It defines our notion of materiality and so on. And it also sets very broad requirements for anything for which there is not yet a separate IFRS sustainability standard. So its scope is very broad, but that scope will narrow over time as we issue more standards. So let me just run through these bullets. The first one, the scope is sustainability related risks and opportunities to the extent that they're material to investors. So notice the language of risks and opportunities. There's an inherently forward-looking focus here. Risks and opportunities, by their very nature, are concerned with things that might or might not happen in the future. That doesn't mean an entirely forward-looking emphasis. So if you think about emissions that were actually emitted last year, these are directly comparable with financial accounting information. They are performance of an historical period, as it were. Next bullet point on TCFD. You'll probably be familiar with TCFD, given its importance in the UK. We have very explicitly adopted TCFD as the structure for our sustainability standards. So running throughout them all will be, and currently through S1 and S2, governance, strategy, risk management, targets and metrics. That's gone down well with stakeholders. And again, it emphasizes that if you're thinking about forward-looking transition planning and risks and opportunities, then it's not enough just to report performance. You need to report governance structures that are in place. How well does your board understand these things? How often does it talk about them? You need to have some insight into strategy, into transition plan, into scenario analysis, and so on. Okay, so third bullet point, industry-specific disclosures. Sustainability issues vary by industry. So there is a difference here between us and IASB. IASB standards, as you know, are essentially industry agnostic, right? You have a standard for insurance contracts, and if you happen to have a lot of insurance contracts, you're probably an insurance company, right? But there isn't an insurance company standard, insurance sector standard as such. Whereas for us, we've adopted the ISSB standards, the Sustainability Accounting Standards Board standards, which are entirely sector based, and we will develop those over time, so that we get to information that's material to investors about the specific sustainability related issues by sector or by industry. Fourth bullet point, S1 points to ISSB standards and to GRI and to ESRS in particular as places where you can go for guidance on sustainability related disclosures other than climate. And again, this is a stepping stone. This is we will have our own standards in those other spaces in due course, but not yet. Final point is that we're not tied to ISSB. These standards can be used with US GAAP or any other accounting standards. That's important, but it's worth emphasizing also connectedness with ISSB is hugely important for us. So the fact that ISSB is currently doing a project on climate-related risks or more broadly risks in financial statements is complementary with our work and very welcome. Next slide, please. So our next standard is S2. S2 very explicitly modelled on TCFD. So what you'll find in TCFD, you'll also find in S2, but just with greater rigour, with greater focus on it being mandatory and what the implications of it being mandatory. But it's TCFD plus, essentially. So if you're already doing TCFD, you're in a really good place to adopt this. I think, yeah, the other bullets on that I've already described. What I would say is that S1 and S2 sort of wrote themselves. It was pretty obvious that we needed to do these two standards first. A general standard and climate is the obvious place to start. And we had a lot of groundwork to build on, right? So with already having TCFD and so on in place, S2 was relatively straightforward to write, I would say. We've just completed an agenda consultation, and so we're asking for, what should we do next, as it were? And this is where it gets more difficult. So we do not yet know what S3 is going to be and what S4 is going to be, and so on. The deliberations on that start this month. So the board will start discussing those issues this month. The agenda consultation having closed on the 1st of September. I think that might be the last slide. Is there another one? No, that's the last slide. So let's go to a discussion and Q&A and so on.
Thank you. This is really excellent scene setting there. And obviously for the UK, we know that your standards will be adopted in the UK. We don't yet know exactly by whom, but the government has made it fairly clear that over a period of time, the scope and reach of these will expand and reach to many companies. So it's really important we start thinking about this early. So thank you. I mean, I guess if we put it in a little bit of context for the UK, many companies have for many years produced CSR reports. They might have been influenced by the work of the GRI or other bodies. It may be things that they've just initiated themselves and prepared. But many of those are focused on these impacts on the outside world, on environment and stakeholders. I wonder if you could say how the focus, the content, maybe even the form of your standards sort of compares to that traditional model of sustainability reporting.
It's a really good question, and I think it's actually a really important sort of mindset shift, which is focusing on reporting to investors. So this is not to say that reporting to investors is in some sense sufficient if you think about the broader societal sustainability challenge, but in the context of IFRS, the focus is reporting on investors. And that is different from reporting your impact on stakeholders, but it's related, right? So in our climate standard, we have a requirement to report Scope 1, Scope 2, and Scope 3 emissions. And emissions are impact data, right? What contribution, as it were, it's a strange word, contribution. What contribution is the company making to global warming? That's not a financial return question, that's a societal impact question, right? But those data are important because if you've got a large carbon footprint, then you're going to have to do something about it. The economics are very clear in terms of direction of travel. You're not going to be able to sustain a business model on that basis. So your investors need to know, well, go on then, tell me your transition plan. Do you have the technology? Is the market with you? Are you going to lose business? Or is there market opportunity for you? So understanding impact can be relevant to investors, but that's not the focus. Importantly, therefore, again, a difference with financial accounting. Financial accounting is directly oriented towards investors. It's financial numbers, right? Whereas sustainability data are just, as it were, a statement of the problem, right? Emissions are a statement of, okay, we've got a large footprint. That's the problem. We need to fix it, and the fixing is the financial bit, right? And that's what the investors want to know. They want to know what's the capital expenditure, what are the operating expenditures, how does your business model change, and so on. So translating into financial effects, that's absolutely core in all of this. But also, critically, it's not all about impact, it's also about dependency, right? So impact would be, how does your business affect the world? Dependency is, how is your business affected by the world? You and I, Anthony, were both on the advisory board to the Treasury, and the Treasury is in the process of adopting TCFD. And I had a chat with a couple of people there a few weeks ago, and they were asking, what does it mean? How should we think about it? How does it fit with ISSB and so on? And it was clear in that discussion that they were thinking about reporting on sort of climate change committee type reporting, which is, what's our impact? How do we reduce our impact? And the example I gave them to sort of refocus was, what's it going to cost you to build a new Thames flood barrier? And so that's not anything to do with the UK's own impact, let alone the UK government impact, but it's a financial issue that is going to have to be budgeted for, right? That is coming, right? The current barriers, fixing it's going to be expensive. That's a climate-related issue, and it's an expensive climate-related issue, and that's what they need to be on top of. So if you think about examples like that, it forces your mind to, okay, how does climate affect us? And it either affects us because the Thames is going to flood, or it affects us because we're going to have to decarbonize our infrastructure, or whatever it happens to be.
Yeah. And that shift towards it's a sort of translation and interpretation point, isn't it? We can think about the impacts, but then we've got to translate them back to interpret that. What does it mean to us, the company, and thereby what will it mean to our investors?
Exactly. And notice, in terms of the audience on this call, that is actually a much more comfortable space if you're an accounting finance type person, because we've been doing that forever, right? So if you think about communicating to investors, in part you communicate, this is our profit for the year, and this is the level of debt or something, but also you're communicating to a degree, these are earnings and free cash flow forecasts and so on, and also this is our strategy. This is how you should understand our R&D pipeline or our marketing strategy, whatever it happens to be. So all the kind of intangible value creating things that are part of communicating to investors, are the skill set in doing that is the same as the skill set here, actually. It's not so far apart.
Yeah. And And whilst we're focused on climate related, because that's one of your first standards, these same issues apply around human capital, etc.
Absolutely.
A few questions have come up just about the UK, so I'll just quickly kind of respond to them. In terms of the timeline, well, the likely timeline is 2025 for the first wave of adopters, and the FCA are going to be consulting on that. The subsequent timeline isn't yet known, but what we do know is the government have committed to these being a feature of the UK reporting framework, and one which they're on their roadmap will expand out, into more listed companies than large private companies, but we don't yet know the full scope of that. But it does look likely 2025 will be the first year. I mean, with those questions on the UK, maybe I could just sort of think about whether the extent to which, in the UK, we have been innovators in narrative reporting. And in fact, coming to this, we're probably going to be an innovator with respect to ISSB. It looks like we will be one of the very first, mandatory adopters of this. But that builds on developments over a number of years where we've innovated, whether it's the Corporate Governance Code, the Strategic Report, Section 172 reporting, all areas he used to help me with when I was at the FRC. But I wonder, for the UK and UK preparing, to what extent do you think those kinds of steps provide a sort of foundation or a stepping stone, if you like, to what these standards will require?
Yeah, I think this is a really, really important issue, and I think the UK is in a really good place, and it's good to be able to say that, actually, And why do I say that? Well, it's a combination of things. The UK has given a lot of thought to this over time, and both at sort of public policy and the corporate level. So things like the Climate Change Act is pretty old at this point, but it was a significant piece of legislation in its time. TCFD adoption, hosting COP26, the strategic report, etc. And the Transition Plan Task Force is the most recent example of this. So there's a lot of UK initiative in this space. That's the first thing to say. Adopting, and also, of course, the UK is the host of the IFRS Foundation. So, adopting S1 and S2 is a very natural extension of the UK existing position and skill set. So that's one thing to say. Another thing is that I describe this as a post-Brexit opportunity, and there aren't many. It's a very political statement, but I genuinely think it is, because I think the UK is in a place to act, to do its own thing, and to operate in a way which is friendly towards and promoting of innovation and in a green transition, as it were. And the value creation opportunities in that space are enormous. So they have to be, right? Because if a future economy that's sustainable is worth more than one that's not, right? And so actually, net there has to be a greater value in investing in a sustainable way than not. And so the more you can focus capital markets in that direction, the greater that is for the wider economy. I think it's pretty clear. And the European position is hard. We'll probably talk about that in a moment, but that's hard work, right? What's going on in Europe right now? So actually, genuinely is a good place for the UK to be. And I would add that there's a lot of UK expertise in sustainability as well. So, and just broadly in the space. So I was just at Carbon Tracker earlier in the week, which is a UK NGO, and it's a leader in the space. Just this morning, reading a Client Earth report, likewise, a leading initiative, etc. So there's a lot of CDP is based in London and so on. So there's a lot of expertise and awareness already in the UK. And I think I'm the busiest board member, apart from the chair and vice chairs, in terms of doing things like this, because of the extent to which the UK gets it, actually. So actually, and that's probably not immediately obvious to those within the UK, and it's in the current climate of the UK not getting it and all kinds of things is an unusual thing to say, but I genuinely think the UK is in a good place.
Yeah, and And I suppose that touches on the broad range of opportunities available, and by being a leader, whether it's in sustainability technology or whether it's in reporting, in sustainability.
Exactly.
In leader. You touched there on Europe, and we're going to be in a position where some UK companies over the coming years will need to apply both ISSB and the European standards.
Yeah.
So perhaps just to clarify that for the attendees, the European Commission has issued European Sustainability Reporting Standards.
Yeah.
On a phased introduction, the first phase is for EU listed companies. But what we see is over a number of years that extending, firstly to UK businesses that perhaps have debt listed in Europe as well as in the UK. But then we also, where we get to it within a relatively short number of years, is even a UK company that sells into Europe, if its activities in Europe are big enough, they'll also be governed or required to follow the ESRS. So this is, we can see this process by which, the extra jurisdictional role of Europe, captures some UK companies. So that begs the question, well, if those companies are also applying the ISSB standards and the European standards, you know where I'm going with this. The big term is interoperability and differing views about how easy it would be to apply the both. I just wonder, what do you think the key differences and challenges are for those?
It's super important issue. So very topical, right? So the way I would see this is, so if you think about investor-oriented sustainability-related disclosure, what we have been able to do, I'm very pleased to say, is consolidate that space, right? So SASB and integrated reporting and CDSB, and by the way, CDSB and integrated reporting both based in the UK, to reinforce the previous point. But those three entities are all no longer independent entities; they're all part of ISSB. CDP will use ISSB data on its platform going forward. So again, another important consolidation. The TCFD itself is sunsetting in favour of its work being continued by the ISSB, and that's kind of always the plan. And of course, IOSCO has endorsed ISSB for global use on capital markets. So the investor-oriented space is very much consolidated. Now, that's progress because multiple standards nobody needs that, right? Now GRI, which has been around the longest in this space, is the other, I would describe the other global standard setter, but it's different from ISSB. So GRI is focused on impact reporting on all stakeholders. So it differs from ISSB in the sense that it's not just investors; it's all other stakeholders. And it differs because it's not, the Thames flood barrier example, it's not focused on dependencies, it's focused on impacts. And so there is, or ought to be, a good relationship between, sort of a complementary relationship between information in GRI standards and information in ISSB standards. So we have an MOU with GRI to that end, still kind of working through how that's supposed to work. But in principle, I think having both actually is a good solution rather than two, because they're doing different things. Meanwhile, national jurisdictions, I think on the whole, we're pretty comfortable with how they are aligning with ISSB. And so we've talked about the UK, the SEC, obviously a critical jurisdiction, and they will issue a climate disclosure rule by the end of the year. That's the latest. But it's going to be unambiguously investor oriented, and the chances of it sort of diverging wildly from ISSB are very, very thin. So there's a good connection there, which leaves ESRS. So the way I'll describe this is, first of all, a couple of genuinely very positive statements. One is the EU is absolutely critical to the success of IFRS in the first place, right? So the EU requiring international financial reporting standards across European countries was absolutely critical trigger in other countries globally doing the same. So Europe has been a really important part of the IFRS story from the beginning. The other thing that is, I think, hugely positive is Europe has had a mandate, a legal mandate, to push ahead on sustainability requirements much faster than other jurisdictions. And it's a difficult thing to do. It's got into all kinds of trouble in doing it and so on. Inevitably, that's what comes with going first. But they have had they've got it more quickly than other jurisdictions. And that's also a big positive. The negative is that you don't need, or it makes no sense to have two sets of investor-oriented sustainability reporting standards. And that's kind of what we've ended up with, but not quite. So the European standards, as you know, are double materiality, right? So the European standards are like ISSB plus GRI pushed together without a dividing line between the two. It's the ESR standards are, if corporate activity or corporate dependency is relevant either to investors or to stakeholders, put it all into a single report. So the implication of that is you cannot do an ESRS sustainability report and say that you've satisfied IFRS reporting requirements, because materiality doesn't just mean include in the report what's useful to investors. It also means don't include in the report information that's not useful to investors. And ESRS by definition includes information that's not useful to investors. So that kind of needs unpacking. So the way the logical way to do this is to apply ISSB, goes back to the building blocks thing, apply ISSB reporting, and then add to that the incremental requirements that are in ESRS. Now, even more sensible, of course, would be for ESRS to start with ISSB and for it to only be the incremental requirements. And in a sense, that's kind of where we're trying to get to. And over time, hopefully with pressure from companies and auditors for that matter, but also just the underlying economics of it. Hopefully that's where we will end up. For the time being, we do have the interoperability question on both sets of standards make specific requests with respect to investor-oriented disclosure, and they're worded differently, and that's just unhelpful. But that's kind of where we are.
Yeah. I mean, it's that point, isn't it? Is that your work is aimed at investors. Their work has two parts. One part aimed at investors, one part aimed at other stakeholders. But you can't disentangle that easily, and hence you get potential conflicts.
That's right. So what we're doing is we're working with them on. So climate is where it very directly overlaps. So we're working with them to provide guidance on here's how you apply both to do climate reporting, and that's critically important.
Yeah. I've covered some of the questions, or tried to cover some of the questions from participants.
Sure.
But there's one here which I think is a bit more specific, which I think is an important question about the nuts and bolts of the standard, which is saying there's references to the detailed industry metrics formerly from the ISSB, but the question is it mandatory? What mandatory metrics do you have? And I guess the question I would add is, where do we think that's going?
Yeah, this is again very important. So the overriding sort of principle behind everything is materiality, right? So even if S2 says you are required to report ABC, it means you are required to report if it's material information for your investors, right? When it comes to the SASB stuff, what we say is you shall consider, right? Yes, I think that's the language. In other words, you are required to look at the SASB standards. You're not required. The metrics themselves are not mandatory, and so you may look at them and say, okay, that's kind of gives me a steer for what is a good metric, and I'll come up with something that's an adjusted version of that. Or you may look at it and say, I just don't recognize that, it's no use to me. Or you may look at it and say, that's exactly what we need, right? But the idea is that there's been a lot of work over a lot of time at industry level developing those standards by SASB. So the idea is that if you're new to this game, not least, you've got a starting point. You've got metrics that have been developed for an industry that are a helpful guide to you in starting the thought process. That's kind of it, really. So the sense in which they're mandatory, I think, has been there's too much anxiety about that, actually. Also, if you look at all of SASB standards added up, it's a lot of pages. But if you're in a particular industry, then that's what you're looking at, and it's actually very, very little. So so it feels onerous, but it's really not actually.
Yeah, and I think we have to remember that those SASB standards were written with the capital markets in mind. So it does give you a kind of leg up in trying to understand what is it that investors are interested.
That's the idea. And over time they will become IFRS standards. I mean, we're keeping it's misleading, but we're keeping the terminology SASB standards because it's an established brand, and because there are users of the SASB standards, quite a lot of users who will carry on using the SASB standards. So we're kind of we're keeping them on as a legacy product, as it were, albeit internationalizing. But over time they will become IFRS standards and go through the due process and so on.
Yeah, sure. I mean, I think for the looking at the difference these standards make, I mean, for me, what I like in them is it looks like an IFRS for me. And by that, I mean, there's a sort of great clarity on what the requirements are.
Yeah.
But it does then beg the question, we move from a world where things are somewhat more open and vague and easier to meet because of that, to one where it's more prescriptive. There's fears about the scale of that kind of that change. So I just wondered, to what extent do you think and I'm going to use the awful term, I said I wouldn't, but to help people on their journey towards complying with these standards, it was an important part of the introduction to TCFD. How have you tried to incorporate that kind of proportionality, time, working on time, etc.
Again, really important, because there is a lot of anxiety out there, and not internationally. I mean, the same kind of issues come up everywhere. So on the sort of the look and feel of the standards, that's not a coincidence, right? One of the things that's been super helpful for us as a new board and all the rest of it has been just following to the letter the IFRS due process. So all the sort of the years of learning that the ISSB has gone through in terms of how to write a standard, we've just lifted and benefited from, and of course including having the former ISSB vice chair as our vice chair, and we've used quite a lot of the technical stuff of the ISSB to help in the drafting and so on as well. So that and lifted some language as well, directly from IFRS. So actually quite a lot of language. So that has been hugely beneficial. That said, of course, you're absolutely right. Sustainability is a different space, and different entities are at a different place in doing sustainability reporting. So we're not in a position of, it's not like IFRS 18 is going to come out fairly soon, right? And that's going to be it's slotted into an existing infrastructure where everyone knows what IFRS 1 to 17 looks like, and it's just you're tinkering at the margins to a degree, but the infrastructure is very well established. Whereas here, there's a bigger question of, well, okay, what is this thing? What are we supposed to do, and how are we supposed to do it, right? And different entities are further along in that process. So, and of course, there's a fundamental difference in the scope of reporting between reporting on activities that you can directly control and reporting on your value chain, and that opens things up enormously. It's essential, but it opens things up. So, I think what we've tried to do here. And it's really important I think in writing standards here that you kind of you shape the way the market evolves rather than being overly prescriptive, because practices being created. So we have these notions of proportionality in there, that information should be reasonable and supportable and available without undue cost and effort. That language is lifted from IFRS 9, I think. So the idea is, look, if you're a large publicly listed insurance company, then the requirement to do a scenario analysis shouldn't be such a difficult thing to do, right? That's kind of your core business. Likewise, if you're a bank or oil and gas or something. If you're a much smaller entity and you've never come across such a thing before, then actually there's three levels of analysis built into the standard, and the lowest of them is purely qualitative. In other words, you're required to do one, but actually what you're being asked to do is just go out and have a look at sort of transition pathways and have a think about how that might shape your strategy, and tell us what you think, right? So the requirements are proportional to the readiness of the company, and in effect also the materiality of the issues to the company. Of course, the quality of data and so on will improve enormously in I think quite a short period of time, because there's going to be so much of a market incentive to create scope 3 data, not just climate, but sort of the equivalent of scope 3 for other issues as well. I think these questions will feel very different in a few years' time than they do now. But for the time being, yes, it will take time. Sorry, one more thought, and this is also, I think, really important. What investors want to know is, how are you thinking about this? What have you got? Where are you up to? Right, this is the journey thing, right? So they don't want you to say, they don't want the company to say, look, we're not ready yet, the answer is 0. They want the company to say, well, we reckon there's probably maybe 70% of our emissions are scope 3, and they're mostly upstream, and they're mostly in these processes. And those, and we're going to tell you the degree of estimation that goes into, we're really not sure about those numbers, right? But it's around about that. That's what, right? So, and over time, those numbers will get refined. And keep in mind that, because the information is material, and only information is material, if you're the board of a company and you don't have estimations of those things, you've got to ask yourself, why not?
Yeah. I mean, and that's the thing as well, isn't it? As you're required to report more, it forces you to think more. It helps you to identify these things more. And it's a catalyst for more comprehensive kind of governance discussions around this. Just one other question that's come up, and quite a slightly more techy one, but I think it links to what you were just talking about scenarios and development scenarios. And so I'll read it as it said. It's right, your Thames flood barrier question, and as if you used that in conversation with me a couple of times, it might help you expand it even more. How do you select the moderate requirement as a potential scenario for consideration? That there is some minor differences, etc., rather than, for example, some 7-meter increase in sea levels requiring the abandonment of London completely. So I guess at the heart of this is, how do you look at a range of scenarios and work out where in that we need to be for reporting purposes?
Now, the reason that feels like a great question to me, and the reason it feels like a great question, is because it is a question and not to which there isn't a good answer, right? So what it illustrates is the kind of question that is provoked by introducing standards of this type, right? Now, because that's what we need to be thinking about, right? And because you don't get to those questions if you think, well, it didn't flood last year, so we're probably going to be fine next year, right? Which is, in a sense, is is the sort of business as usual model, right? And if you're running, if you suppose you are, I don't know who pays for the Thames flood barrier, but suppose you're the UK, suppose the UK government thing, and well, the question is, well, how should we be thinking about this, right? And we can't not be thinking about this because of the scale of it, right? It's a bit of an HS2 job, right? So maybe we need to be getting our climate modeling people to give us some scenarios about what the risks are, right? And on the basis of those, then you into kind of in a sense conventional project planning, right? And sort of strategy work and sort of scenario work and so on. And then, but there's no right answer to that. But what will happen is that norms of practice will start to evolve, which there aren't currently in answering questions of that type, right? And so, are we focused on the most likely scenario here? Are we focused on how do we plan for the possibility of an extreme? And how do we report on the possibility of an extreme? What that would mean for the UK government finances? And you see what I mean? So I don't think there are obvious answers, but I think there are lots of obvious questions, and they will lead us collectively towards norms for reporting on these things.
And in the end, what investors are looking for here is especially when you get these broader questions of risk, opportunities, potential impact on strategy, how you are governing those, how your governance structures respond to those risks. it isn't about saying there's this single answer and compare my single answer to
Absolutely,
that
absolutely,
single answer.
absolutely.
It's about
Yeah.
it's about how are you going about answering these questions.
Yeah, and it's about business resilience, and
Yeah,
do
exactly.
you understand business? So,
Yeah.
give you a couple of live examples. One which I'm fond of using because it really illustrates the the sort of hard-nosed economics involved in this, which is State Farm insurance in the US. So State Farm's it's all states, sorry. I can't remember which one's which. Anyway, one of the two is the US's largest, and they're both involved in the same way. One is the US's largest property insurer and the largest in California. And so they will have built that market share over goodness knows how many years, and it's been a profitable business, etc., etc. They have stopped writing new property insurance policies in California, citing catastrophe risk, that they're not worth underwriting. It's too risky for them. So
Yeah.
now that's a big that is a straightforward commercial economic decision, right? They're walking away from a lot of business. Now, insurance companies are good at risk. That's what they do, right? So the implication of that decision, the direct implication, is that businesses and individuals are increasingly going to insure themselves. Now, that should give people pause for thought, but even more, maybe businesses operating in California need to be thinking, well, hang on, if they're making that decision, maybe we should be thinking more about this. Or maybe we should be thinking, is it more difficult to attract employees to work? Will it become more difficult because it's going to be more expensive for them to live here and more uncertain? Should we be building this new facility in an area where we might need to abandon etc. Right? So so there ought to be knock-on implications of that kind of a leading edge decision. Another example is the oil and gas industry. So if you think about the downstream, the burning of oil and gas is it emits a certain amount of carbon, fine, but it sort of doesn't matter where it comes from. But the upstream activity, or the own operations activity, varies enormously in its carbon footprint. So a big part of the footprint of the industry is the extraction. And if you're a Canadian oil company in comparison with a Saudi oil company, your cost of your environmental cost of extraction is much higher. So if you think about a global decline in demand for oil and gas, you'd expect those at the Canadian end of the spectrum, on environmental grounds, to become non-viable sooner than the rest, right? And so you ought to be seeing in the financial statements, you would expect to be starting to see assumptions about shorter asset lives and assumptions about decommissioning costs being brought forward and remeasured. And this anecdote is coming from a conversation with a Canadian pension fund. They're saying, well, A, we're not seeing this, and B, we're not seeing information that tells us why we're not seeing this, right? So again, those are the sorts of issues that ought to be. I can't remember how I started on this now, but those are the sorts of issues that ought to be starting to get triggered.
Yes.
Which require looking ahead and working backwards rather than thinking last year and business as usual.
It's again back to the point that that whilst the number one focus of this is to provide information to investors, the obvious byproduct of it should be better business thinking. It should be better
exactly
decision making. But I've got a lot more questions I would love to ask you, but we're running out of time. There is one that has come up. Well, actually, two connected. Any updates on the UK SDS along with IFRS? Well, I'll answer that. The process of reviewing the standards for adoption is underway, and that the government's plan is for that to be complete by June next year. But the other one I think is an interesting one. I think you might have already touched on this, which in effect is there a plan to create a portal for S1 and S2 information similar to the CDP? But I think what you're saying is CDP are looking to change their data set requirements to be compliant with that S1 and S2. That's right, isn't it?
Yeah, and that type of model for us is of course much more comfortable. That's what the market is good at. That's what the market ought to be left to do, and it's better not to to conflate the writing the rules with the the
with
data.
the delivery of the information or the handle of the information. But yeah. So I think to that question, that there will be an alignment, but the alignment will be through the work of CDP in terms of changes
Yeah.
Well, look, Richard, it's been such a pleasure and a privilege for you to join us. I hope you've enjoyed that session, and so have our attendees. I know I have. So thank you very much. And to those attending, the usual thing, we will, in the next couple of days, we will share a link to the video and also a copy of the slides, which I know are very brief in this case, but that will come in the next few days. But other than that, thank you very much, Richard.
Thanks for inviting me. It's a pleasure.